All right. Good morning. Good afternoon, everyone. I'm Tom Jessop with Fidelity Digital Assets, and we are very pleased to have you here today for another installment of the Value Exchange. Today, we're going to talk about the state of institutional digital asset adoption with our guests, Rick Edelman, who is the founder of both Edelman Financial and someone who doesn't really need an introduction, but most recently the founder of the Digital Asset Council of Financial Professionals, or DACFP. And Rick is someone who's really leading the charge in the advisor community to build awareness and knowledge about the role of digital assets in traditional portfolios. And we're also joined by Peter Jubber, who is the managing director of Fidelity Digital Funds. So welcome, Rick and Peter. I'm going to ask you to introduce yourselves in just a minute, but just to tee up the topic for today, we are going to talk about the state of adoption in the U.S. and really using the most recent version of our client survey, the results of which were published in September, which really highlighted some very interesting trends among institutions and their relationship with digital assets. What we've seen year on year, and this is a study we've done now for 3 years, is that we are seeing an increase in the current ownership of digital assets, and importantly, an increase in future purchase intent. We're also seeing significant year-on-year increases in interest in digital asset investment products as separate and distinct from owning these assets directly, perhaps as an acknowledgement that as the space develops, advisors and their clients are looking for experts who understand the space to provide diversified and unique exposure to this emerging asset class. What we've also seen is that on a segment basis, financial advisors and family offices have shown significant increases year on year in adoption of digital assets. So for some of the segments we'll talk about today, we're seeing pretty strong acceleration of interest. And then finally, and this is probably most promising for the future of this space, there's an increasing amount of awareness around innovation in the space. So interest is evolving from Bitcoin as sort of the gateway digital asset for many advisors and their clients. And there's a lot more recognition of the power of the technology as it relates to things like central bank digital currencies and tokenization of traditional asset types. Just as a reminder, please submit questions to the Q&A. We'll reserve about 10 minutes at the end of the session to ask Rick and Peter a few questions that you submit. So with that, Rick, I know most of our audience is very familiar with you and your what you've done for the industry, but maybe give us a little bit of background on what you're doing now with the DACFP.
Thanks, Tom. Great to be with you both here on the program. Most folks, I think, are familiar with my background in building Edelman Financial Engines, the largest RIA in the country with about $300 billion in assets now. What folks don't often know is my journey into the world of digital assets. I got started in 2012. That's when I first heard about Bitcoin. And it didn't take long for me to realize two facts. First, blockchain and digital assets are the most transformative innovation for global commerce since the invention of the internet. And second, most financial advisors don't realize this. And as a result, have been largely sitting on the sidelines to a disservice to themselves, their financial planning practices, and their clients who have been excluded from incorporating this asset class into their portfolios. And that's why I created DACFP, is to serve as a bridge connecting the financial advisory community to the crypto community, because the folks in the crypto community are making a lot of really cool products and services that can help financial planners and advisors in their practices and serve their clients in their portfolios. And there aren't very many who can bridge that gap between the two. And so we're an educational organization. We offer the certificate in blockchain and digital assets, an 11-module online self-study, self-paced course with 13 CE credits. It's only $549. You can take the course, binge it in a weekend. You can take months to go through it. 1,000 advisors have already enrolled. And we're really excited about the programming we create, webinars, TV, online, papers, et cetera, to help advisors learn more about this space so you can figure out how and if to incorporate it best into your practice.
Great. It's an idea whose time has come, and I love the bridge analogy. It's something that we use quite frequently when we talk about our business. Peter, quick introduction, please.
Yeah, sure. Peter Jubber. As Tom said, I head up Fidelity Digital Funds, which is our nascent crypto investment management unit here at Fidelity. I've been at Fidelity, nearly 20 years, and have been involved with our early on exposure and journey to digital assets, starting with some scenario planning we did in 2012, and then our early mining operation through the development of some digital wallet work, and then partnering with Tom as we've developed our custody business, and now heading up this small unit focused on investment management.
Great, thank you, Peter. So Rick, to kick things off, one of the, I'd like to focus on the advisor. One of the things I think, when people talk about institutional adoption, maybe implicit in that is that there's like a snap your fingers and suddenly things happen and it's like retail adoption. In fact, that's not how fiduciaries and advisors and other professionals think about the space, right? They need to understand the space. They need to develop a thesis around what is the application of this technology, these assets to my business. And then they have to think about, okay, now that I've got that view, how do I operationalize my interest? And I think you've sort of talked about that as it relates to advisors. So, where do you see advisors now in terms of that, call it three-step journey from, realization to actually doing something in the space? Where is the industry at this point in time?
Yeah, your survey results that you mentioned, Tom, are really fascinating, and you're showing that the adoption rate in the advisory community is growing, and in fact, it's growing exponentially. When I got started in this space, 9 years ago, when I first started talking about this, the common question was, why are you doing this? Why are you investing and buying Bitcoin and these other wacky things? Why are you doing that? It's morphing. Now the question is increasingly, when you talk to advisors, why aren't you doing this? So advisors, I think, are being pulled along in this. Most advisors are doing it reluctantly. We'd rather not engage in this. I mean, let's face it, most advisors have been in this business for decades. We're running very successful practices, managing hundreds of millions or billions of dollars in assets. Clients are happy. I'm getting to play golf a day a week, so what's not to love? Why should I bother with anything new and different, especially something as bizarre as this, which I know nothing about, seems to have nothing in common with anything else that I do or any other investment I'm familiar with, that sure looks like tulip bulbs and beanie babies. If it's not a fraud, it's a fad. Why would I want to get engaged in this? So advisors have been dismissive of this for years, and it's largely only because clients are now increasingly asking about it. Competition is increasingly engaging in it, and mainstream media is increasingly talking about it, that advisors are beginning to realize, all right, whether I like it or not, I guess I better get aware, get familiar, become knowledgeable, because the old hand dismissiveness, oh, ignore it, it's a fad, it's a fraud, it's a tulip bulb or beanie baby, throw it away, ignore it, pay no attention. That answer worked in 2015. That answer doesn't work in 2021. So advisors have to learn about this. And the way that I kind of put the conversation, Tom, is that I equate it to annuities. Every advisor in the country has a very strong opinion about annuities. Love them or hate them, we have strong opinions. And it's pretty well known that I'm not a fan of annuities. But when a client asks me about annuities, I can talk at great length about their features, their benefits, their risks, the fees, the details, why I don't like them, the differences between fixed and variable, between bonus annuities and income annuities. I am an expert in annuities. Doesn't mean I use them, doesn't mean I like them, but I am highly fluent in an annuity conversation, meaning I can serve my client. I can answer my client's questions and explain to them why annuities do or don't fit into their portfolio, who it's good for, when they should use it, how they should use it, the extent they should use it, etc. I challenge advisors to do the same thing with digital assets. You need to become fluent in this conversation, because until you are fluent, you can't intelligently, meaningfully, responsibly explain to a client, or frankly, a regulator, why you are or are not incorporating digital assets into your portfolio. So advisors need to learn about this. It ain't going away. It's becoming increasingly mainstream, and it will become increasingly dominant and important in portfolio allocation. And advisors need to get off this nonsense of it's a fad or it's a fraud and go deeper into the technology to understand why there's a there.
Yeah, so Rick, it's interesting, if So we've seen this too, right? There's a lot of reverse inquiry. Like you can't ignore what's happening in the rest of the world, and some of that is bleeding into this segment. But when you think about, like, for example, in a survey year on year, there was a 20% increase in the number of advisors who have invested themselves or for their clients in digital assets. How much of that growth do you think is still just the growth in the reverse inquiry versus advisors starting to think about where this fits in a financial planner portfolio? And what does that look like over the next couple of years? Do you think that it will continue to be more of a, well, I'll do it if my client wants it? Or do we morph into something where there's a construct where an advisor can talk about the role of these assets in a portfolio?
Yeah, I think it varies by the advisor. Those who are not terribly aware or knowledgeable of the space will shrug their shoulders and say, if the client gets proactive, if the client asks me for it, I'll shrug my shoulders and say, fine, I'll give it to you. It's kind of like the Jamie Dimon approach. Dimon has said he hates Bitcoin. He doesn't believe in it, but he says if clients want it, we'll give it to them. That's a smart business move. It's the client's money. If they want it, give it to them. If you don't give it to them, they're going to go elsewhere to go get it.
Right.
And that's part of what your survey results have shown, along with other survey results from NYDIG and others, that clients are expecting their advisor to be able to help them. And if they can't, they're going to go to another advisor.
Yeah.
So I think you're right. A lot of advisors are giving it the, okay, if you want it, and if you ask for it, I'll figure out a way to provide it. But I think that is morphing. Advisors are beginning to realize, as they learn more about it themselves, this can improve portfolio modeling. Classic MPT and the efficient frontier. We know Bitcoin is a risky asset. We also know that adding risky assets to a portfolio lowers the risk of the portfolio. So Bitcoin actually improves the Sharpe ratio, the Sortino, the max drawdown. It improves all this data. So we can do a better job for our clients by adding it. And once advisors begin to get a hold of that, they become more and more proactive, showing their clients the benefits to the portfolio of including this asset within the allocation.
Yeah, I mean, certainly over longer period. Sorry, Peter, go ahead, jump in.
I would agree. Everything Rick is saying, we're seeing on the ground with advisors at Fidelity. It's client demand led. Advisors are looking for solutions to kind of meet client needs, but they're not proactively going out there saying you should be invested in crypto. And Rick, you correctly point out that there's a place in a portfolio for it. And I think the risk is now switching from, boy, it's riskier for me to invest you in crypto, is now becoming riskier to not invest you in crypto. And I think advisors need to, as you say, educate themselves. The other thing I'll really add is, there's not a handy product for advisors to use to kind of get people into crypto, especially Bitcoin. And so, we just saw the futures-based ETF go live, and I think that's a reasonable product, but I'm not sure it fits well for advisors. And we think a spot-based ETF.
Peter, we need to really elaborate on that. That's a hugely important point. A big reason today, this is different from 5 years ago, but today, a big reason that advisors are not engaging isn't because they don't like the idea. It isn't because they're in dispute of it. It's because from a practice management perspective, they don't know an easy way to do it. Planners don't want complexity in their practice, and I don't blame them. One of the big things that we want to do is focus on our client. We want to spend time with our clients. We don't want to spend time with our back office. We don't want to deal with operations and trading and compliance. We want to make our lives easy and simple so that we can focus on our clients. And as you said, Peter, you said it best, Bitcoin is cumbersome, and so cumbersome that many compliance departments simply say, no, we're not going to allow you to do it in this way because we can't control the client experience. Many exchanges don't even work with the advisor community. So even if you wanted to buy Bitcoin for a client, you go to Coinbase, for example, you can't even do your job in that environment. This administratively causes advisors to sit on the sidelines. Here's the good news. Today, there are a wide array of opportunities, a wide array of products available that allow advisors to engage in a practice management environment that makes it seamless and easy as the rest of your practice. You can do bulk trading for your entire book of business. You can rebalance. You can do tax management. You can collect your fee. That's a biggie. Let's not forget that. You can incorporate this into your practice very easily, very seamlessly, using ETFs that allow you to buy individual securities, that do OTC securities. You can buy MicroStrategy or Riot Blockchain that give you effective proxies. Fidelity offers an array of options and opportunities through Fidelity's digital assets division that you all represent here. The excuse of I can't, or my compliance office won't let me, or I don't know how, those are just excuses now. It's no longer a legitimate reason for not participating or engaging.
Yeah, fair point. Peter, let's talk a little bit more about product. One of the surprising things about the survey in terms of year-on-year growth was the, what I would say in some segments, a decided preference now for product for many of the reasons that you and Rick just outlined, right? It can be incorporated into the practice. It's easy. The advisors can get paid on it, which, is still very difficult to do in terms of holding the assets directly. So talk a little bit about the survey results and what you think it portends for product now that we've got these ETFs in market and private funds, and what does that look like to you?
So yeah, so I'll just provide a little more detail, Rick, on the point you made, which is there are many different options. So starting at private funds, which are quite broadly available and are priced pretty effectively, but have kind of heavy friction to get in and out of them. And then you got OTC products; they've got their own hair on them. The NAV does not always trade, the vehicle does not always trade at NAV. As you say, you could buy MicroStrategy, so you can do public equity exposure. Those are indirect proxies for Bitcoin themselves. You could literally buy futures directly on the CME, or you could buy a futures-based ETF. Every one of the products that I've just described has got a compromise, but there's no shortage of them compared to just 2 years ago for advisors to seek the right exposure for their investors. In my mind, the ETP that is spot-based is the ultimate expression of Bitcoin exposure for advisors. It is the most pure expression, and it will be the highest, offer the highest liquidity and lowest fees when it does get approved. So, Tom, I think what we're seeing reflected in the survey is an interest to have products available that, to Rick's point, fit within the workflow of the way the advisor manages their practice, so that they don't have to worry about that, and that they can focus on business development and client service instead. So they're looking for that easiest in answer, and I think that's what we're seeing reflected in the survey results.
Great. Rick, so we're at a point now where, as Peter said, more product available to advisors to incorporate into their current book of business and practice, but where, you're doing a lot of this educational work, bringing the industry along, once you get to the point of passive exposure, what's next? Where do you see the product set evolving in the advisor community, once they're past the 1-2% allocation to Bitcoin or some other asset? What's the opportunity there for advisors?
Well, there's a very large array. If you're just getting started in this space, or if your client is, taking baby steps. I'm the guy who invented back in 2015 the 1% allocation strategy. So I'm a big believer that you really don't need to allocate a large portion of the portfolio. This is counterintuitive because we generally know that if you don't allocate a meaningful portion of the portfolio, why bother? I don't think any of us would tell a client to buy one share of Microsoft. What point would that serve? So this is why we put 60% of assets into stocks, because if you're not going to do that, why bother? But you don't have to put 10 or 20 or 30% of your money into crypto. And we don't want to, because we know the risks. This could still blow up for any one of a number of reasons. So this is causing a lot of advisors to sit on the sidelines. I don't want to do a lot, and it's pointless to do a little, therefore I'll do none. That's all wrong. You can actually materially improve the portfolio. You can increase the return while reducing the risk with a mere 1% allocation. And if you're going to do just 1%, just buy Bitcoin, call it a day. Bitcoin is what, 70, 80% of the total market? So just buy Bitcoin and be done. If you want, you could buy Bitcoin and Ethereum. Between the two of them, you've got 80 or 90% of the market, and you're done. If you want to go a step further, you could further diversify. For example, with something like BITW, the Bitwise Top 10 Crypto Index Fund, which is the 10 largest coins by market cap. So there are a variety of ways you could engage in this way, and it makes it simple and easy to do it. But once you go down that rabbit hole, to your point, Tom, once you begin to learn more about this space and you begin to look at the different players that are existing in this space and the different investment opportunities, companies like MicroStrategy, or Tesla or PayPal or Square or Mass Mutual that are engaging in this, or the Bitcoin miners that are publicly traded like Riot Blockchain or Marathon Digital, or the ETFs that are available that are engaging in the picks and shovels. Do the Levi Strauss approach to gold. Don't buy gold, sell the gold miners blue jeans. So there are a dozen ETFs that do this already. Once you begin to do this, you begin to realize there are a lot of ways to engage in this ecosystem. I don't have to build cars. I could buy stock in the concrete companies that are building the roads. And then I'll go buy paint companies because they're painting those roads. So you can engage in the picks and shovels separately from the blockchain and Bitcoin engagers directly. And once you begin to do this, you become more comfortable that maybe I can go from 1% to 2%, maybe even 3% of the portfolio. I'm still not talking about 10 or 20 or 30. Yale, in fact, did a study in 2018, and they said that even if you think that Bitcoin will outperform by 200% per year, your allocation ought to be 6% of the portfolio.
Yeah,
exactly right. Even if you are wildly optimistic, Bitcoin does not deserve a huge allocation. So if this is freaking you out about the whole conversation, keep in mind, a 1% allocation to Bitcoin translates to you spending about 1% of your time talking about it to clients. This isn't a dominant conversation. You shouldn't be focusing all your attention on this. It's not a big deal. So take baby steps, put your toe in the water, and you'll discover the water's fine. Come on in.
Yeah, that's great. Sorry, Peter, go ahead.
Well, and the vast majority of clients are in the kind of crypto newbie space, and so it's that very first conversation, and it should be focused on Bitcoin or Ethereum at most. That said, we are seeing some pretty sophisticated investors that are looking for something more. And so, Tom, if we think about products that go beyond passive, multi-coin strategies that have a different flavor than just market cap is kind of one approach that we're looking at. Yield funds. How do you generate income off of underlying digital assets that could make them more attractive to investors, or even ones that dampen the volatility we see in products today? And so those we think are, there's a significant interest in the survey data for so-called actively managed product. And so we're just engaging with investors to kind of understand what they mean by that. And we think they mean, well, how do we get beyond passive? And so I think the vast majority of investors should first be exposed to passive, but there is a small group of people that are interested in these more alpha generating types of strategies.
And to that point, something really important is that I think it's safe to say that most advisors have a lot of clients who are accredited investors. And there is a much broader array of private placements and funds available to accredited investors that advisors ought to pay attention to, because to Peter's point, there are some really neat products that are being made available, hedge funds, funds of funds, venture capital, private equity, that are all engaging, if not directly in digital assets. Some of them are. They're doing long short strategies, they're doing leverage strategies, they're doing lending and staking, and others are doing extensive picks and shovels activities. So there's a wide array of investment opportunity that isn't, unfortunately, available to the ordinary retail client.
Yeah, and Rick, just to pick up on that, one of the things we also test in our survey is, are these assets viewed as their own discrete asset class, or are they seen as really being part of the alts allocation bucket? And I think, not to put words in your mouth, but I think you've come to a view, I think, which we had was, at some percentage, it's a diversifying, returns enhancing addition to a core portfolio. But how do you think about the difference between that core portfolio and then obviously the increasing interest in advisors and their clients in the alt space? Would you say that certain digital assets are core and some of these things we just talked about would be part of an alt allocation? How does that play out, or is that kind of a distinction without a difference?
Yeah, I think it's the latter point. No,
Okay.
it's tomato, tomato. I really don't care what you call it. My personal preference, the approach I've always taken, I don't believe in the alts category because it's too generic. It's
Fine.
sort of, it's not a stock, it's not a bond, therefore it's an alt. It's too nondescriptive for me. So I would rather be specific. So there's commodities, there's natural resources, there's exponential technologies, there's precious metals, there's digital assets. So I'd rather be more specific, but it really, at the end of the day, doesn't really matter.
Fair enough. Maybe pivoting a bit, let's talk about some of the potential, obviously education is one, but other blockers. When our survey consistently, some of the things that come up as reasons why not to allocate or reasons to be concerned, volatility is number one. Regulation is up there, although I think year on year, the concern about regulation has declined a bit. And my take on that is the same way when people were investing in emerging or frontier markets in the 90s, at some point you realize that the risk of, misappropriation by governments or nationalization or other, lack of a well-formed legal construct for investors, that's just part of the risk equation. There's not much you can do about it. And perhaps that's what we're seeing here as investors understand that it's going to take time to get this sorted out. But what are some of the, whether it's volatility, whether it's regulation, what do you think advisors need? Like, what would you tell advisors? How should they be processing some of that noise, some of the whipsawing that we're seeing in what is still a fairly immature asset class?
Well, there's no question that this is an emerging technology. And there's a lot of unknowns. We don't know yet how it'll play out. We don't, there's, as you pointed out, there's competitive threat, there's regulatory threat, there's technological threat, there's government threat, there's hacker risk, there's all kinds of stuff that could go wrong. And even if none of that happens, there are 11,000 coins. We don't need 11,000. At the end of the day, there's probably going to be a couple of dozen that survive. Because that's about all you're probably going to need. That's all the differentiation necessary. I mean, look at every major industry. In the soft drink industry, Coke and Pepsi have 90% market share. In the airline industry, Delta and United, probably between the two of them, have 60% market share. In the computer industry, it's Dell and Microsoft and Apple have 90% market share. So when you get to a mature state, it's always a few companies that dominate. And then you've got a few others that are on the fringe. That'll probably be how this shakes out as well. So we don't know, even if it does survive, which are the main players. Back in 1920, there were 200 automobile manufacturers in the United States. Today, there are 3. So this is likely going to be the future of digital assets as well. It'll morph and it'll consolidate. So because we don't know exactly how the future will shake out, that's why we limit ourselves to 1 or 2% of the portfolio. Be directionally correct as opposed to being precisely wrong. If you just go with Bitcoin or Bitcoin and Ethereum, call it a day, you'll be directionally correct. And that's probably going to be sufficient to generate above average returns at below average risk. You might not have the best returns, but I don't think that's what most advisors are seeking. We're seeking an exposure to the asset class. We're not necessarily trying to be 100% absolutely correctly perfect.
Yeah, I mean, that's very sensible, right? Which is, in effect, don't follow the blow by blow of the regulatory discussions in DC or other things. Get yourself a bit of exposure, and you can limit your exposure to those risks by virtue of the percentage of those assets in your portfolio.
Now, one thing you said, Tom, that I do want to push back on, because a lot of advisors share the comment you made, which is why you made it, is that one of the fears or one of the risks that are perceived is the volatility.
Yeah.
And that is simply incorrect. And the proof I have are advisors themselves. Your clients express concern over volatility in the stock market. Every time we go through 1987, 2001, 2008, clients freak out over stock market volatility. And advisors know how to respond to that. We assure clients that volatility is part of the game of investing. Over the long term, it works its way out. That every time the markets drop dramatically, it leads later to all-time highs, and you dollar cost average and you rebalance in order to reduce the risk of volatility. Volatility handled correctly is your friend. It's the same conversation with Bitcoin. So you can't use volatility as a reason for not investing, because if you're going to do that, how do you explain investing in stocks? And by the way, in 2020, a third of the stocks in the S&P 500, a third of them were more volatile than Bitcoin. So let's just throw away that volatility conversation because it's a canard.
Yeah, I mean, I agree. I mean, there's a time dimension, there's a exposure dimension. It's not just the absolute volatility of an asset, right? And I think people tend to focus on that because that's what they're seeing when they, fire up their Bloomberg terminal or look at the price of Bitcoin on a day-to-day basis. Peter, what's your perspective as someone who's obviously been fighting the good fight with some of the investment products that we're looking to develop? What's your perspective on regulation and kind of where that's happening, broadly as it relates to this space?
Yeah, so I'll go back a few years, and I think we had a period of time when, the SEC, as an example, was not really engaging with the crypto industry, except to just say no to, new product ideas. I think more recently we've seen greater levels of engagement, but we're seeing regulators ask providers to fit their intentions into existing structures. So 40 Act regulation, and we've seen that emerge most recently with the futures-based ETFs. Tom, I think it's a conversation around the ongoing maturation of the crypto markets. We've seen since 2019, even early 2020, a ton of maturation, greater volumes, and very tight spreads in many of the markets where Bitcoin and Ethereum are traded. And if you look at Bitcoin itself, the maturity in the futures market, the maturity in the spot market, we think are indicators that it's time for approval of a spot-based ETP. And we think the regulators are engaging, we are experiencing the fact that they're engaging in the conversation. The part that's unknown is the timing. And so I think optimistically, you could look to the latter part of this year, but I think realistically, you've got to look into next year for an approval of a product of that type.
Got it. Rick, from your perspective, I mean, there's obviously a lot of regulatory focus, is something a security or not? Is lending against crypto a security or not? But as it relates to the advisor community, are there any hot button regulatory issues that if you said, look, if we could get clarity on one or two things, it would call it improve the receptiveness or posture, or is it just more the broader set of issues that people look at and say, boy, there's a lot to fix there?
No, I think that from a regulatory perspective, there's sufficient clarity, number one. In other words, we have a very clear path forward of engaging right now, and we have sufficient products available that allow us to do that. So it might be difficult for advisors in some cases to buy Bitcoin directly for a client or to manage direct Bitcoin holdings on behalf of a group of clients or your entire book of business. But if that's true in your practice, and there are lots of ways around that, you could, for example, use Choice at Kingdom Trust, where disclosure, I'm an investor there, in addition to having an account. Same true with Bitwise that I mentioned earlier. You could open an IRA account on behalf of all of your clients and buy Bitcoin and Ethereum and dozens of other coins directly. And by the way, Kingdom Trust custodies with Fidelity. So you've got two outstanding organizations doing this. Kingdom Trust manages $20 billion in assets. So this is a very substantial company clearing and custodying through Fidelity. So you've got a high degree of confidence there. So you could buy Bitcoin directly for IRAs with your clients very seamlessly and easily. But if you feel uncomfortable or your compliance department is an issue with that, there are a wide variety of ETFs on the market, OTC securities on the market, where you could buy these in your brokerage account at Fidelity or whoever you custody with, just as you do all your other mutual funds and ETFs. It's seamless, it's easy, it's a natural part of your practice management where you can rebalance dollar cost average, do tax management, and collect your fee very simply and easily. So there's really no issue for advisors to say, oh, regulations don't permit it. That's nonsense. Regulations are very clear on this matter, and there's no more scary, there are no more uncertain than any other ETF or mutual fund in the marketplace.
Yeah, that's a great observation. We'd like to get to Q&A in a minute, but maybe just to sort of round out the discussion about the survey, the other thing we've seen in our business, and it's exciting, is this idea that once people dip a toe in the water, they start to understand the space and the technology. It really opens their eyes to the art of the possible, right? And I think for me, the analogy is, remember the first website or internet application we all used back in the 90s? I'm obviously old enough to remember that. It was the thing that gave you a sense of the possible and what could the internet do. And I think, Peter, maybe just to bring us home, do you want to talk a little bit about some of the survey feedback around things like central bank digital currencies and tokenization, which I think is an expression of this growing awareness of the game-changing nature of the technology?
Yeah, and so, I won't go into all the details of what a stablecoin is, but I can talk a little about kind of their purpose. So the stablecoins are effectively a great way to kind of allow investors to trade amongst crypto tokens. And so it's kind of your USD version of your account to allow you to trade in and out of alternative crypto tokens. And so the emergence of stable coins has certainly lowered the friction for investors to trade and be exposed to alternative tokens. I think another interesting development, Tom, as you point out, is central bank digital currencies. So we're all aware of what China is doing with respect to launching one. I think they're the closest economy to launching a full-blown CBDC. Sweden and Singapore are farthest along on their pilot testing. And we might even see smaller countries like Thailand launch something as well, besides China. The Bank of International Settlements is engaging very heavily with their members, including the Fed, to kind of see if there's a way to syndicate and align on standards around CBDC issuance and usage. But the current thinking here is US, maybe 5 years out, EU maybe 3 to 5 years out. And the advantages are obvious, so for central bankers, this is a way to simplify the implementation of monetary and fiscal policy. It can also promote financial inclusion for under or unbanked individuals in the economy. But there are implications, and one simple one is, boy, if you have people shifting money from their bank deposits into a digital cash account, does that reduce banks' abilities, reserves, and abilities to lend? So I just think there are many implications of CBDCs in general that have to be worked out. The other thing I'll say is that, I fully expect that CBDCs and stablecoins will sit alongside each other. They perform, related but different functions and are complementary. I also fully expect that we'll see a continued regulation in the stablecoin space to align it more to the overall structure of the regulatory environment here in the US.
Great. Thanks, Peter. So why don't we open the floor to questions? Hopefully we have a few. If you haven't submitted a question and would like to, please use the Q&A function in Zoom. Rebecca, Chris, Kyle, anyone, do we have any questions for either Rick or Peter?
Yeah, Tom, I have you covered here. We have a lot of questions, so apologies that we won't be able to get to all of them. Maybe we'll try and do a follow-up with some more answers. So thank you, everyone. Question, Tom, maybe suited best for you to take this one, but open up to everyone. Can you please talk about the state of custody solutions for digital assets, and to what extent are these solutions investment grade, in quotes, from the view of one of the biggest asset managers? Perhaps also institutional grade, I think is what maybe they're referring to as well.
Yeah, look, I would say, and ask Rick to weigh in as well from a more of a customer market standpoint. Look, the state of the entire market infrastructure for crypto has evolved dramatically. If you look at the available liquidity for Bitcoin, for example, 24/7, very tight spreads, it's there in size. That was a question a couple of years ago. If you look at custodial solutions 3 to 4 years ago, you had hedge funds that were sharing passwords to effectively a retail crypto account to manage their business. Now you have our business and others where we provide sophisticated operational controls to the client so they can manage according to their own risk and security footprint. At the same time, we've invested a lot in our technical infrastructure, our operational and physical controls, to the point where Big Four accountancies are ready, willing, and able to come in and audit our operations and our or balances on a semi-annual basis. So I would say for most investors just voting with their money and allocating to the space, that these solutions have quickly become mainstream and institutional. Rick, you mentioned Kingdom Trust, but any other perspective there?
Yeah, part of the problem is strictly from a marketing and a perception perspective. Most of the players in this space are nascent to this space, meaning the crypto community are largely startups that are unique to that community, and they are not household names. Many of them are new companies. I mean, if you look at a crypto company that has been around for 4 years, that's a long time. And so that raises concern among investors as well as their advisors. Who are these people? In many cases, in virtually all cases, they don't have a physical location, no branch offices. I don't know where they're located. I don't even know if they're domiciled in the US. I don't know who the principals are. And that adds a little fear or uncertainty to what is already a scary conversation in the first place about Bitcoin itself. So there aren't very many companies that have a household brand name, that have been around for decades, that are managing trillions of dollars of assets. And you can tell I'm describing Fidelity here. So one way that you can help provide confidence to your client is by using one of those household names. Back in the 60s, if you were a corporate exec and you had to buy a typewriter, you bought an IBM Selectric. Why? Mm-hmm. Because of the phrase, remember, if you're old enough, nobody ever got fired buying IBM. And so you buy the household brand name because it eliminates one area of risk or uncertainty. Now, you might not want to go to Fidelity Digital directly because you don't want to buy Bitcoin directly. But what's interesting is that a lot of those crypto companies that are new, that are relatively unknown, like you probably never heard of Kingdom Trust. But when you find out that Kingdom Trust is using Fidelity as their custodian, there are lots of companies, and you can rattle them off, Tom, I'm sure pretty easily, who are custodying their digital assets with Fidelity. So when you're doing your due diligence, when you're looking at the companies that are providing access to this asset class, ask them, where do you custody the coins? And you'll often discover, oh, well, we use Fidelity. And that provides a great deal of confidence that you can use with your client. It takes away one of the areas of uncertainty and unknowns that helps facilitate the whole process.
Good. Thank you, Rick. Steve, next question.
Sure. Maybe we'll direct this one to Rick. Probably takes a registered individual to really comment on this in depth. Can you comment on the futures roll cost of BITO, the new futures ETF, versus the discount on GBTC? Obviously, this individual says, obviously direct asset is best, but should we be more worried about that futures roll cost on BITO?
Well, yeah, there's a lot of excitement and certainly attention about the rollout this week of Bitcoin futures ETFs. And we've got one so far with ProShares, and another half a dozen are going to come online within the next week or two. This is not the Holy Grail. We as advisors want a Bitcoin ETF. That's the Holy Grail. We all know ETFs. We love ETFs for all the obvious reasons: low cost, transparency, accessibility. Clients are familiar with them. They're easily adapted to our portfolios. We can rebalance very easily. We can dollar cost average, debit our fee. It's very simple and easy. We all love ETFs. A Bitcoin futures ETF is a step in that direction. It's further evidence of the legitimacy of this asset class, the fact that the SEC said yes, but it's not quite the Holy Grail of a Bitcoin ETF itself, for the simple reason that you're not buying Bitcoin. You're buying futures contracts on Bitcoin. And if you're a sophisticated trader who understands the futures market, then okay, this can make sense in the portfolio. But recognize that if you put your client into an S&P 500 index fund, are you putting your client into S&P 500 futures? And if not, why not? And if you're not buying futures in the stock market, why do you want to buy futures in the Bitcoin market? So recognize that these are different. They're not, Bitcoin futures is not the same as Bitcoin. Futures trade with their own pricing that might deviate from Bitcoin itself. And as the questioner noted, there's a lot of expense to buying those futures contracts. The total annual expenses are projected to be 6 or 7% a year, in addition to the expense ratio of the ETF itself. So there are expenses you need to deal with. GBTC, on the other hand, as an OTC traded security, which is currently trading at a discount, is allowing you to buy $1 worth of Bitcoin for 85 cents. So a lot of people are considering this a bargain. That's on the assumption that the OTC security becomes an ETF if the SEC ever allows that, and that discount will disappear. So you've got to recognize that that discount is kind of like the closed-end mutual fund world where discounts and premiums exist. You need to learn about them and make sure you understand them. I've got a great article on this subject at our website at dacfp.com to help you understand this. So you need to be aware of how these products work. It's part of your due diligence and educational effort, which we provide a lot of through our certification course at DACFP. So it's a good question. And if all of that is news to you, understanding how Bitcoin futures work, understanding how the premium discount works with OTC securities, it's illustrative of the fact you've got some learning to do.
All right, I think we have time maybe, Steve, for one more question.
Yeah. Why don't we end it with a question around energy? Will proof of work evolve into proof of stake? And if not, how will this energy consumption issue be resolved? Are there additional, if it does not change, are there additional risks to consider?
Yeah, happy to take that. It's a very common complaint of Bitcoin. It uses mining, which means computers are doing complex calculations to perform the function of the network, and those computers eat a lot of energy. And therefore, people say Bitcoin's bad for the planet because of all the energy consumption. That argument is a bit of a canard. Much of the energy that the Bitcoin network is using is excess energy. It's not wasted energy that is otherwise would have been used to power houses and factories. A lot of Bitcoin mining is done solar, geothermal. In El Salvador, for example, they're using volcanic energy to mine the Bitcoin. Many Bitcoin miners are alongside hydroelectric dams. It's literally water that otherwise would have been wasted in energy consumption. So a lot of it is not harmful to the ecology at all. And in fact, it's really about CO2 levels. It's not about energy. It's about how much bad environmental impact is there really. Nobody has more motivation in the world of commerce to go to a zero ecological footprint than Bitcoin miners, because that's their #1 expense. So how are we going to solve it? The way that the rest of the world is going to solve the energy crisis, we're going to go solar. So as we improve wind, solar, water energy, we're going to use that and apply it to Bitcoin as well. But in the short run, if it bothers you that Bitcoin is using a lot of energy, don't buy Bitcoin. Instead, buy Ethereum, because Ethereum is shifting from a mining methodology to a proof of stake methodology, which doesn't use mining and is not an energy hog. So there are a lot of coins that don't incur the mining problem. So if it bothers you, then simply buy the coins that are not not an energy crisis. So lots of ways you can play in the space to appeal to your concern about ecological issues.
Great. So with that, we're almost on the hour. I'd like to thank Rick and Peter for joining us this morning. It was a great conversation. If folks are interested in learning more about DACFP, they can visit dacfp.com to look at some of the programs that Rick mentioned, and also a plethora of educational materials that will help advisors move further down the path of understanding the space. You can also visit fidelitydigitalassets.com, where you can find a copy of our institutional survey. And again, other research that will help all of you as you begin to broaden your horizons in this new asset class. So thank you very much. And we look forward to seeing some of you at the next installment of the Value Exchange. Thank you.